As global financial markets approach the end of 2025, the precious metals space has captured unprecedented attention. Gold, long considered the quintessential safe haven asset, has smashed through multiple historical ceilings, climbing relentlessly to levels never seen before. Spot gold approached and in some sessions surpassed $4,180 to $4,500 per ounce, reflecting an extraordinary surge driven by a potent blend of macroeconomic pressures, geopolitical risk, and evolving investor psychology. At the same time, silver, traditionally more volatile, has also recorded record breakthroughs flirting with $70 an ounce, and beyond, a rally that has outpaced gold's percentage gains and drawn both fascination and caution from global markets and individual investors alike. The scale of the 2025 precious metals rally is remarkable. Spot gold has gained roughly 67%, 70% year-to-date, shattering multi-decade records and breaching inflection points like $3,000 and $4,000 an ounce that once seemed distant milestones. Silver's run has been even more striking, with increases approaching 138%, 140% year-to-date, driven by robust demand from both investment funds and industrial sectors that utilize silver in technologies from solar energy to electronics. Understanding why this rally has unfolded requires looking at a convergence of global forces. For gold, the most powerful underlying theme is investors' search for stability amid deepening economic and geopolitical uncertainties. Throughout December 2025, heightened tensions related to energy markets, particularly uncertainties involving Venezuelan oil supply routes and broader diplomatic friction, amplified fear in traditional asset classes. These dynamics sparked a classic flight to safety, pushing funds and individual investors toward gold as a hedge against potential market downturns. Layered on top of geopolitical unease are reverberations from global monetary policy. The U.S. Federal Reserve, mindful of slowing economic indicators and a weakened labor market, has increasingly priced in the possibility of interest rate cuts through 2026. Markets are now embedding expectations of at least 2 rate reductions next year, a shift that dramatically alters the landscape for non-yielding assets like gold and silver. Lower interest rates diminish the opportunity cost of holding these metals, making them more attractive relative to bonds and savings accounts with diminishing real returns. With the Federal Reserve signaling a dovish tilt, precious metals have benefited from an influx of capital-seeking returns outside traditional fixed-income instruments. Compounding this trend is the relative weakness of the U.S. dollar. A softer dollar tends to make dollar-priced commodities like gold and silver more affordable for holders of other currencies, stimulating additional buying pressure from international markets. This dynamic has created a feedback loop of price support that has extended the rally well beyond typical cyclical patterns, even at times of reduced trading volume in thin holiday markets. Silver's explosive ascent, while connected to many of the same drivers, carries its own unique characteristics. Beyond safe haven flows, silver plays a dual role as both a financial and industrial metal. Unlike gold, silver has significant demand from sectors tied to renewable energy, electronics manufacturing, and emerging technologies. For example, solar panels and electric vehicles rely on silver's conductive properties, which has maintained strong industrial demand even as financial markets have fluctuated. This dual demand structure helps explain why silver's percentage gains have outpaced gold's throughout 2025. Investors see not only a hedge against economic risk, but also exposure to future industrial growth. Silver's smaller, less liquid market compared to gold amplifies price moves. In tight markets with constrained supply and surging demand, silver experiences larger swings, both on the upside and potentially on the downside. Over the past month, silver's rally has been especially rapid, with its spot price advancing significantly in a compact window of trading sessions. This kind of momentum can attract speculative capital, seeking quick gains, and pushes prices toward extreme levels that could eventually trigger profit-taking or short-term corrections. But until sentiment shifts, silver continues to track with, and at times outshine, gold's ascent. Notably, central banks and institutional investors have been accumulating gold reserves at heightened rates. Official sector demand, especially among emerging market central banks, has provided structural support to gold's price trajectory. Diversification away from reliance on any single reserve currency, particularly amid debates about the long-term role of the U.S. dollar as the global reserve currency, has favored tangible assets like gold. Strong central bank appetites for gold add a layer of demand stability that is harder to reverse quickly, even in the face of periodic market sentiment swings. However, the current context also carries cautionary signals. While gold's upward momentum appears robust, silver's rapid gains have prompted some analysts to ask whether the white metal might be forming a near-term top in its rally. Large short-term spikes in asset prices often precede consolidation phases, where prices stabilize or pull back as investors take profits. This does not negate the broader bullish trend, but suggests that volatility, especially in silver, may remain elevated. As markets thin out near year-end, even modest shifts in trading behavior can trigger outsized price swings in both directions. In addition, seasonal effects traditionally influence precious metals markets. Historically, the final weeks of December have occasionally generated strong returns as traders lock in positions and rebalance portfolios before year-end. While seasonality alone would not account for the entire scale of 2025's rally, it does intersect with macroeconomic and geopolitical drivers, further reinforcing bullish price action during this period. The interplay between monetary policy expectations and geopolitical risk has also reshaped commodity market correlations. Traditionally, rising gold prices may coincide with weakening equities or bond yields in times of crisis. However, in late 2025, gold and silver have climbed even as some equity markets hover near seasonal highs. This suggests a broader risk rebalancing process, where investors are not simply fleeing stocks, but reallocating capital from risk-bearing assets to tangible stores of value. The persistent climb in precious metals reflects deeper sentiment shifts about the stability of global financial systems. In local markets around the world, including South Asia and the Middle East, these international price trends have translated into historic local price levels for gold and silver. For example, in India and Pakistan, 24-karat gold and silver prices have reached record local currency peaks, mirroring international market forces and demonstrating the global cohesion of this rally. These local records highlight how global macro forces influence everyday commodity pricing in regional economies. Despite the remarkable performance, some analysts warn that this surge bears elements of a market-perfect storm. The combination of expected rate cuts, geopolitical uncertainty, safe haven demand, industrial consumption, and speculative momentum has driven prices to levels that, while justified by underlying fundamentals, raise questions about sustainability. Markets that move rapidly can be prone to corrections once one or more supporting drivers ease or reverse. For example, if inflation moderates significantly, or if the Federal Reserve signals a slower pace of rate cuts than expected, investors might recalibrate positions, leading to short-term retrenchment in precious metals. Overall, the story of late 2025 precious metals is one of extraordinary convergence. Gold's breakout to record highs represents one of the most powerful rallies in decades, grounded in safe haven psychology and monetary policy dynamics. Silver's extraordinary climb underscores both its financial role and its industrial appeal, even as its volatility suggests careful observer scrutiny. As investors assess their portfolios for 2026, the dynamics shaping gold and silver in 2025, from global currency pressures and geopolitical risk to market sentiment and technical momentum, will remain central to understanding the broader financial landscape going forward. As 2025 draws to a close, precious metals have not only dominated headlines, they have fundamentally reshaped how investors think about global risk, monetary policy, and portfolio construction. Gold's unprecedented climb toward and above $4,500 per ounce has captivated institutional capital and retail savers alike, while silver's explosive move above $70 per ounce has fueled debate over whether this rally still has room to run or is edging toward a near-term top. Looking ahead into 2026, the outlook for both metals continues to lean bullish overall, but with distinct risk profiles, drivers, and strategic considerations that every serious investor, especially one committed to halal and ethical frameworks, should understand. One of the most consistent themes emerging from major institutions is the continuation of gold's upward trajectory into 2026. According to forecasts aggregated from banks and research groups, gold is expected to average near $4,500 per ounce during 2026 and reach between $4,800 and $5,000 by year-end. Some forecasts are even more aggressive, with leading investment houses projecting gold could breach $5,000 per ounce as sustained central bank buying, further monetary easing by the U.S. Federal Reserve, and ongoing geopolitical tensions keep safe haven demand elevated. This broad institutional consensus reflects a recognition that the structural factors driving this year's record highs are not transitory. Central banks, especially in Asia and emerging markets, have been accumulating gold to diversify foreign exchange reserves away from concentrated reliance on the U.S. dollar. This diversification trend, coupled with expectations of lower real interest rates and further rate cuts by the Fed, creates a regime where non-yielding assets such as gold become comparatively more attractive. Another key support for continued gold strength is the persistent geopolitical uncertainty that has defined 2025. Rather than easing, tensions in regions such as the Middle East and in energy supply chains remain unresolved, intensifying demand for bullion as a hedge against unpredictable market shocks. This flight to safety dynamic has historically propelled gold through periods of risk aversion, and analysts believe this pattern may persist well into 2026. While these bullish forecasts anchor the long-term narrative, it's important to understand that precious metals do not move in straight lines. Volatility, especially in silver, means that prices may experience periods of consolidation or pullback before resuming higher. In fact, many analysts anticipate that silver could face near-term tops or sideways trading ranges before breaking out further. Industry commentary suggests that after such a dramatic surge in 2025, silver may consolidate in the $50–$60 range in early 2026, before testing higher levels later in the year. This pattern is not unique to silver. In asset markets powered by momentum, strong rallies are often punctuated by phases where prices stabilize or retrace modestly before the next leg up. For silver, which serves both as a precious metal and a critical industrial commodity for technologies like solar panels and electric vehicles, the interplay between investment demand and industrial use is central to its medium-term outlook. Even as some traders take profits after this year's gains, the supply deficit and strong industrial demand forecast continue to support higher long-term pricing. Unlike gold, silver's industrial dimension introduces additional drivers and risks. As the global economy progresses toward electrification, demand for silver in battery and power systems could act as a structural growth engine. Forecasts for silver through 2026 vary more widely than for gold. Estimates range from modest gains to more ambitious projections of $65–$70 per ounce by year-end 2026, with some analysts suggesting even higher potential if industrial adoption accelerates faster than production growth. However, volatility remains a defining feature of silver's price action. The metal's dual nature means it can spike quickly on safe haven inflows, but also correct sharply if industrial demand softens or if global risk sentiment improves rapidly. As a result, strategies for silver often emphasize risk management and tactical positioning more than for gold, which tends to behave as a steadier hedge asset. A critical strategic takeaway for 2026 is the importance of portfolio diversification. While precious metals, particularly gold, are poised for continued strength, holding them within a balanced mix of assets helps mitigate the impact of market swings. Diversification can involve allocating a percentage of one's portfolio to gold as a hedge against inflation and currency debasement, while positioning silver exposure more tactically based on industrial cycles and risk appetite. Halal investors may also consider real assets such as commodities, real estate, or halal equities that provide complementary exposure to growth sectors without violating ethical constraints. Another factor likely to shape 2026 is the US dollar's trajectory. Many forecasts point to a softer dollar amid continuing expectations of Fed rate cuts and rising fiscal deficits. A weaker dollar historically boosts USD-priced commodities like gold and silver, making them more attractive to global buyers. However, should dollar strength re-emerge unexpectedly, precious metals could face near-term pressure. This underscores the importance of monitoring macroeconomic signals, including inflation data, employment reports, and central bank communications, as part of an informed investment strategy. Investor psychology in precious metals markets is equally vital. After massive gains in 2025, some signal that markets may enter a consolidation phase where short-term profit-taking tempers momentum. Others warn of potential cyclical corrections if macroeconomic conditions shift suddenly. For example, if inflation moderates faster than expected, or if geopolitical tensions ease significantly. While these scenarios are less likely to derail the long-term bullish trend, they highlight the need for patient investment horizons rather than frantic trading. Institutional positioning also matters. Continued inflows into gold physical holdings by sovereign and private investors can create a supportive base that absorbs selling pressure during corrections. For silver, the balance between investment inflows and industrial demand will determine whether consolidation remains shallow or deepens into a broader trend. Given the heightened attention silver has received following its extraordinary 2025 performance, market participants should anticipate choppier price action in the first half of 2026 before clearer directional signals emerge. In conclusion, the 2026 outlook for gold and silver remains broadly positive but nuanced. Gold's role as a safe haven hedge, fortified by monetary policy expectations, geopolitical risk, and institutional demand, underpins forecasts that see prices climbing toward and potentially beyond $5,000 per ounce. Silver's trajectory, while also bullish, is subject to greater volatility and industrial demand dynamics that could shape its path differently. Investors, especially those seeking halal, ethical exposure, may benefit from longer-term perspectives, physical ownership, and disciplined risk management, rather than short-term speculative strategies. By combining macroeconomic awareness with ethical investment principles, 2026 can be a year of opportunity for those seeking to navigate the evolving landscape of precious metals with clarity and prudence.